Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, here for a kind of an addendum to a Boots on the Ground episode we did with our good friend Chris Funk from Southern Impression Homes. Chris, thanks for coming back.
Good to see you, sir.
Yeah, we pulled him over. So we just did a pretty long segment just breaking down the market of Jacksonville, Ocala, Florida, and Palm Coast, and look at some of the trends there, because obviously with the issues that people are dealing with is you've got situations where rents are rising, but prices are rising. Builders are facing all kinds of difficulties, and it makes it hard for them to honor a contract 6, 8, 9 months down the road from a contract they wrote today. And that's just what happens with inflation. So that's why they have clauses in their contracts for them to basically adjust the price so that they can maintain their margin. You might think, well, that's not fair. Well, and it's not really fair for anyone to ask anybody in this type of environment to predict what the future is going to be, or on a mass scale, eat all those losses. Yeah, you might get one good deal, but then if you put the builder out of business, there's no more inventory coming. And so it's really not in anybody's best interest to force somebody to swallow something that didn't make sense, because if the shoe was on the other foot, and that's exactly the case, what if the contract said, hey, Mr. Investor, you need to close on this no matter what, even if you can no longer afford it because the interest rate doubled? It sucks to be you, right? So it goes either way. So with that said, once you get out of this adversarial posturing that sometimes a novice investor will get into, and you realize, okay, the person on the other side of this transaction has got some issues that we've got to try to deal with, and I've got some issues now that I've got to try to deal with because interest rates have risen. How do we get the deal done, or does it even make sense? Well, in the last episode, what we were really talking about is, does it even make sense? Right? If you're bullish on a market, is it worth kind of stretching, or is it worth taking a little bit more risk, if you will, in order to get in? Because if the market takes off, if the rents take off and the prices take off and you're not in, you lose all that. If the interest rates go up further instead of coming back down, then you lose the opportunity to get the interest rates that, tomorrow are going to look pretty good. But you don't know that today. Today, they look pretty bad because you're comparing them to a year ago. So it's really hard to know. But once you've made up your mind, hey, I really want to try to make this thing work, now you got to do the math. I say all the time, do the math, and the math will tell you what to do. Or a simpler version is, the math is the path. And so I've asked Chris to kind of break down into a little bit of a dialogue here, the presentations and the spreadsheets that he and his team, when they're dealing with the investors. So before we do that, Chris, just talk a little bit about the life cycle from the time somebody comes to you and says, yes, Chris, I'm interested, I'd like to buy a property. Describe, they get into contract. What are they obligated to? What are you obligated to? What is the flexibility down the road in the contract if circumstances change beyond a range where it's reasonable to expect either party to go through with the transaction as originally scripted? What's that look like?
Sure. Yeah. Well, so some of our processes have changed here as a result of just the inflationary environment that we've been in. So, you were alluding earlier to, the fact that over the last couple of years, we've had to do price increases. So we've had to utilize price escalation clauses in our contracts, which, is obviously nothing that we ever want to do. And clearly our customers don't want to see that either.
And those aren't profit increases.
No,
Those are price increases because the costs increased.
Exactly. Yeah, those are definitely not profit increases. Our margins are significantly lower, even when we do a price increase, than they ever would have been at the initial contract price if everything had stayed the same. So it's been a painful couple of years, honestly. The building market has been incredibly difficult to operate in, just because supplies are short order. There's not enough labor. It's hard to get houses built, but the costs are going up. And, all of these things, but that's, we've all heard that. It's all over the news. But, what do we do to fix it? And, from our perspective, we just decided, hey, we just can't continue to go down these price increase, conversations with our clients. So in June of this year, actually, so just, 2 months ago, 3 months ago, we changed a policy where, we will no longer give our clients the option of lots that aren't already under construction. So, in all of our history in the past, we would show everybody a variety of lots and say, hey, pick whichever one you want and we'll go build a house on it for you. Well, the reality is, we can't price a house, 6 months, a year before
because that adds too much to the lead time. So if they pick a lot that's already under construction, you've taken a lot of the time out, and the risk is everything changes over time.
Exactly. And it's just changed so rapidly in the last 2 years, there's just no way to account for it. I mean, it's absolutely impossible. If you accounted for, a 40% increase in building costs, well, then nobody would have contracted on a house with you to begin with. So,
right.
But as a result, to your question, we still have a price escalation clause in our agreement, but the way that it's written is that, that escalation clause goes into effect, based on the time period between when the contract was written and the time period when construction commences. So now we're only selling homes after construction is commenced. So it essentially wipes out the need for price increases, because at that point in time, we know what the cost to build the home is. So that's a big change that's happened for us. But to further answer your question, essentially our buyers, when they contract on a home with us, they put down a 10% deposit, and that's it. That's all they have to come up with until it's time to close on the home. So the buyer is committed to 10%. We're committed to 90% of the cost to build a home until that home is CO'd. And that means certificate of occupancy. So until somebody can inhabit that property. So, we take 90% of the risk in the build cost. So if a homeowner got to the end of the end of the road and said, hey, I can't close on this property. Well, they would lose their 10%. But we would be stuck, holding the bag on the other 90% of the transaction.
Okay, so I want to keep this quick because I've got just another 5 minutes, and I want to get in. When you sit down and talk with someone about either buying or trying to figure out, exactly what it is they're doing, your team has put together a pretty detailed Proforma.
Yep.
Which is a projection of expenses and return on investment, all that
let me
stuff.
Go through that.
Yeah, we're going to go through that. So let me just put it up on the screen. And
Perfect.
so one of the things that people do, and I have a background in the mortgage business, is we use interest only loans, because when you can take the need to make the amortization, the pay down of the loan go, it improves the cash flow. So I've got the controls here, Chris, and I'm going to try to walk through this, but we're not going to get into the square footage. But this is a property, a 6-bed fourplex, or what you call a quadruplex, that's selling for $720,000 basically. The down payment would be about $180,000. There's some closing costs. There's the amount of money you invest with a property management team to get the thing leased up. And so this is how much out of pocket, roughly $195,000. And so that's the amount of capital the investor comes in. They're going to pair that with a mortgage. In this case, we're doing 75% loan to value, a loan of about $540,000. And we're using this interest only option. And you had a lender there at the field trip a couple weeks ago, and this is a thing again, which is great. And some people think, oh, well, I wouldn't want an interest only option. Let me just deal with that right away, right? Folks, you want an interest only option because it gives you the option, but not the obligation to make a smaller payment. If you feel like you want to add a little extra principal and amortize that loan, God bless you, go ahead and do it. But it means that if cash flow gets tight, you don't have to make the payment. You're not in default if all you do is pay the interest. Personally, they're my favorite kind of loans. And I could make an argument for them, but I'm not going to do that. In this case, the interest only period lasts for 5 years. So you've got 5 years to work, to let the market do its magic and work the rents up. And, if you saw the previous section and some of the reasons why we like these markets, I think you'll have reason to believe that, that's a possibility, if not a probability. Nothing in life is guaranteed, but there's some really underlying factors that are solid. at the time of this recording, which is August, and I think you probably put this together in early August, using an interest rate of 6.25, which I believe is market based on what you guys are experiencing. And so you can kind of look at these numbers. And then down here, you have, all of the costs. And I'd like to make a comment, Chris, and I know I'm monologuing here a little bit, but that's because, again, I have the controls and I'm trying to get through this real quick, but I do want to give you a chance to comment a little bit. We mentioned in the past segment, you guys are managing 2,000 properties in your portfolio right now in your property management. So when you
Correct.
do a pro forma, you're not pulling these numbers out of a hat. You actually know what these things cost because you're dealing with it on a daily basis. Is that right?
Correct. Yep. And and we do try to be conservative on these things as well. So we're not we're not saying that the picture is going to be rosy the whole way through. So you'll see even on these pro formas, we throw in things like maintenance. Well, at least in year one, you really shouldn't have much in the way of maintenance. There's a builder warranty on the property. So unless a tenant does something that they don't pay for, there really should not be a maintenance charge there.
Yeah. So then, that's the whole idea with build to rent. Another reason why we like it. We like build to rent because you've got a lot of inventory available. Typically, you don't do build to rent on a one-off basis. You got lots of properties available. You're dealing directly with the builder typically, which is great. They're in it for their reputation as a builder. In this case, you're also a property manager. So when you show somebody projected rents and what you think you can do and what expenses are, that's based on real life experience. And you've actually got to put your money where your mouth is because you're going to be managing these properties. Well, at least you offer to. I guess people aren't under an obligation to use you, but I think they would want to. But you can see that when you look at that, your cash flows are still, on an annual basis, they're a little bit thin. I mean, you're positive, so you should be very happy about that. With amortization, you might be next to negative or very close to break even. So this is the comfort level you get by using that interest only option. And then you project out, hey, if we have a growth in rents and if we have a growth in equity, this is kind of what you could look for. We're not going to get into all that right now because that's not the point. You shouldn't do this doesn't mean anything to you unless you believe in the market. If you believe in the market and what's going on in that market, then you can have a sense that some of these projections are going to work. What we're trying to do is figure out how do you get in and hold on to the property. So if you buy a brand new property, you don't have deferred maintenance. You don't have to worry about a lot of those hidden expenses. If you have really good, accurate numbers on your pro forma based on real world, and again, when you're managing 2,000 properties, it's going to be pretty accurate in terms of what your rents and expenses are going to be because it's coming from real world data. You have a great property management team with good marketing that can keep the thing leased up and push those rents because the underlying demand, if people are waiting in line, then they're going to buy the properties. Then you can begin to believe, okay, there's a chance for me to be able to hold on to this property for 5 years with this interest only option and allow the rents to come to me. Okay. It's not as great as being able to do a value add and push it, but again, that's a lot more CapEx. So, interest only is a great option. Another option that Chris has done, and this is his 30-year fully amortized loan, is driving the interest rate down. And so, Chris, how do you do that?
So lenders now are offering a rate buy down option. So this rate would have been close to 6% amortizing, which would have created very low cash flow. But by buying down the rate, which in this case cost 1.5%, the rate was able to be bought down to 4.99%. Now, again, it's fully amortizing. So the cash flow is still a little bit lower than the 6.5% or 6.25% interest only loan, but still positive cash flow.
Good. That's awesome. So if you can look here, you'll see the cash flows are very similar, but this is a fully amortizing loan. So you're getting a little bit of equity buildup, which is nice, but your cash flow is no better. You got the lower interest rate, so that's good. So it's just two different ways to get the job done. I don't know. Maybe it would be possible to buy the rate down and get an interest only loan. That would be fantastic. I don't know. We're not here to tell you how to do it or what to do. We're just letting you know that when you're working with someone who's in it with you for the long haul, like Chris and his team, and that there are ways to be able to make the numbers make sense. And you have to make a decision if you're willing to be that thin, if you're bullish enough on the market. Because you can say, well, gosh, 6.25, I'd rather wait till the interest rates come down. Well, if interest rates go up, and I've had interest, my very first rental property, my interest rate was nearly 13. So if interest rates go up, you're going to be really glad you have that 6.25. If interest rates go down from here, then that means you're going to be able to refinance. But it also means that as interest rates go down, the prices will probably go up further and you're going to gain in equity. Typically, that's what happens. So you're going to be really glad that you have that 6.25, even if interest rates go down. And so you just have to think about that, right? If rents go up and continue to go up, you're going to be glad that you locked in all of your costs today because you're the beneficiary of those rental increases. So go back and watch the previous segment that we did where we talked about all that. Chris, I'd love to chat more with you about this. I've just hit my hard stop, so I
All
got to
right.
bounce. But folks, if you're interested in going through this with Chris and his team and learning what these numbers look like in the real world at whatever point in time you're watching this based on the inventory that's available and what's going on in the interest rate markets, this is kind of analysis they'll help you do. It's no obligation. It's just helping you make a good decision. Watch the other one about the market and then engage with Chris and his team and see if they can help you see if this market and these property finance structures make sense for you. Chris, I'll give you the last word. Anything you'd like to say?
It was good to see you, my friend. You have a great one. I know you got to run.
Okay, appreciate you. Thanks so much.
Thank you. Bye-bye.